Ladies and gentlemen, if you've been watching the global markets closely, you already know something is shifting beneath the surface. Capital is moving quietly but decisively, and some of the smartest investors in the world are changing course. Today, I want to outline why a significant number of them are leaving the speculative comfort of crypto assets and positioning themselves into silver as we step into 2025. Capital is moving, but it is not moving loudly. It is moving in a slow, deliberate, almost invisible current beneath the noise of the market. And if you pay close attention, you begin to see what seasoned investors have always understood. Money flows to where value is most secure, not where excitement is the highest. Over the last decade, much of the enthusiasm centered around speculative assets without intrinsic value, without historical grounding, and without a proven relationship to real economic cycles. But speculation has its limits, and the market always reveals them eventually. What we are witnessing now is a rotation away from that speculative environment and into tangibles, into assets that carry weight, utility, and a track record that spans lifetimes rather than seasons. This shift was not triggered by a single event. It was shaped by inflation that proved more persistent than predicted, by debt levels reaching territory no financial system can sustain indefinitely, and by a global economy increasingly reliant on real materials rather than digital promises. When liquidity was abundant and interest rates near zero, speculation seemed harmless. It felt like a natural extension of easy money. But as conditions tighten, as credit becomes more expensive, investors are reminded of the fundamental rule of financial history: capital seeks safety when uncertainty rises. Tangibles, real assets you can measure, hold, extract, or utilize, have always been the anchor during periods of financial transition, and investors are rediscovering that truth. Silver, energy metals, land, and other physical resources have begun attracting capital not because of hype, but because of necessity. These assets do not depend on sentiment to validate their worth. Their value is grounded in function, scarcity, and time. Silver stands at an interesting intersection of this rotation. It is both a monetary metal and an industrial metal, giving it a dual role that speculative assets can never replicate. Its importance in solar energy, electronics, medical technology, and power infrastructure continues to grow, yet its price does not reflect the scale of its essential role. Investors who study supply-demand dynamics see a widening gap. Industrial demand is rising, mining output is stagnant, and above-ground inventories are declining. This is not speculation. It is structural reality. It is one of the clearest signs of mispricing in the entire commodities space. Contrast this with speculative assets that gain popularity because of momentum rather than fundamentals. These assets rely heavily on confidence, and when that confidence wanes, liquidity evaporates quickly. The market learned this lesson repeatedly, yet each cycle seems to remind new participants all over again. Tangible assets, on the other hand, do not need public enthusiasm to maintain value. They are tied to real-world use, and that connection does not dissolve when sentiment shifts. This is precisely why capital begins to rotate during uncertain periods. Investors are not searching for the next mania. They are searching for what will endure. Another factor driving this rotation is the growing understanding that digital speculation does not hedge systemic risk. When currencies weaken, when governments accumulate debt at unsustainable levels, and when monetary policy shifts unexpectedly, speculative assets tend to amplify volatility rather than protect against it. Tangibles, however, have historically acted as stabilizers. They respond to inflation, scarcity, currency debasement in ways speculative assets cannot. Investors with a long-term perspective recognize that the real world does not run on digital abstraction. It runs on energy, metals, food, and resources that have tangible economic value. The rotation toward tangibles is not about abandoning innovation. It is about recognizing the difference between innovation and valuation. Markets can overprice potential just as easily as they can underprice necessity. What is happening now is the repricing of necessity, and the investors making the shift are not reacting emotionally. They are following the same principles that governed capital preservation long before digital assets existed. Seek what is real, what is scarce, and what has survived every major monetary cycle in history. Capital flows are often misunderstood because they are quiet at first. They begin with institutions, long-term allocators, and investors who read balance sheets instead of headlines. By the time the mainstream notices, the majority of the move has already occurred. We are still early in this rotation, but the direction is clear. Markets built on speculation cannot sustain long-term confidence, especially when economic foundations begin to shake. Tangibles are reasserting their role not because they are new or exciting, but because they are essential. This is not the end of speculation. It is simply the beginning of realism. Investors are not abandoning opportunity. They are choosing durability. And in times like these, durability is far more valuable than excitement. When you study the monetary system long enough, you begin to see patterns that repeat century after century. One of the most persistent patterns is the disconnect that occasionally forms between real assets and the amount of currency circulating in the system. Today, that disconnect is extremely visible in silver. Money supply has expanded dramatically over the past decade, yet silver trades as though the world is in a state of monetary restraint. The truth is the opposite. We are living in an era of unprecedented currency creation, rapid debt accumulation, and ongoing dilution of purchasing power. Historically, metals have adjusted upward to reflect this expansion, but silver has not yet made that move. And markets rarely leave such imbalances unresolved for long. Silver's role as money is not a theory or a nostalgic idea. It is a historical fact. For thousands of years, silver preserved purchasing power precisely because its supply could not be expanded by decree. Central banks can issue currency with a keystroke, but silver must be mined, refined, transported, and stored. That limitation has always been the anchor that keeps monetary excess in check. Yet despite its monetary nature, silver is priced today as if we are living in a world of disciplined fiscal management, moderate debt levels, and controlled money creation. Anyone looking at the data knows that is not the case. The money supply has increased far beyond the levels justified by economic output, and silver's price has not responded proportionally. But the monetary argument is only half the story. Silver is not just a monetary metal, it is an industrial engine. Almost every major technological advancement of the last century relies on silver in some capacity. Solar panels require it for conductivity. Electronics depend on it for precision. Medical applications utilize its antimicrobial properties, and the electrification of transportation cannot progress without it. Silver is woven into every layer of modern industry, and demand is rising, not falling. The world is not moving away from silver. It is integrating silver more deeply into critical technologies. Industrial demand for silver is reaching record highs. The solar industry alone consumes hundreds of millions of ounces each year, and though numbers are projected to rise as nations compete to expand renewable energy capacity, at the same time, the mining industry is not keeping pace. Silver grades are declining, new discoveries are scarce, and the cost of extraction continues to rise. You cannot increase industrial production by simply wishing for more silver. The metal must be physically available, and that availability is tightening each year. When you have increasing demand meeting constrained supply, prices eventually adjust to reflect the reality. Yet the current market still treats silver as though it is abundant and easily replenished. This is one of the most significant mispricings in the metal space. Investors who analyze supply-demand fundamentals can see the divergence widening. Industrial consumption is steadily increasing. Above-ground inventories are decreasing, and the gap between mine supply and total demand grows larger with each passing year. These are not speculative forecasts. They are measurable trends. To understand why silver remains undervalued, you must also consider the structure of the market itself. The silver price is heavily influenced by paper contracts rather than physical supply. In a system dominated by leverage and derivatives, the physical fundamentals can be overshadowed in the short term, but they cannot be ignored in the long run. When inventories tighten, when industrial users experience delays, when investment demand increases, the physical market begins to overrule the paper market. That process always happens gradually, then suddenly, silver's monetary and industrial realities have a way of asserting themselves when the imbalance becomes too large to suppress. We also need to recognize that the world is moving toward a more resource-constrained environment. Energy transitions require metals. Technological growth requires metals. Infrastructure renewal requires metals. Currency debasement pushes investors toward metals. Silver sits at the center of all these developments. It is both a store of value and a critical input for future industrial expansion. Few assets carry such dual importance, and even fewer remain undervalued while their relevance grows. When you step back and evaluate the broader picture, the conclusion becomes obvious. Silver is not priced according to its role in the monetary system, nor is it priced according to its role in global industry. It is priced according to short-term sentiment, derivative market pressure, and a general market misunderstanding of how essential silver has become. But sentiment changes, derivatives unwind, reality catches up. And when it does, the adjustment tends to be swift. Silver's undervaluation relative to the money supply and its industrial demand is not permanent. It is an opportunity, the kind that appears only when markets overlook fundamentals in favor of convenience. Those who understand the true nature of silver's position in today's economic environment are not surprised by its current price. They simply recognize it for what it is, a temporary distortion in a long-term trend that favors tangible, essential, and irreplaceable assets. For the better part of the last decade, the investment world has been captivated by the rapid rise, dramatic swings, and bold promises of digital assets. The technology behind them is innovative, the enthusiasm unmistakable, and the price movements nothing short of historic. But every asset class eventually undergoes the same test. It must prove whether it carries enduring value or whether it depends entirely on momentum and sentiment. When you compare the volatility of crypto with the long-term stability silver has provided throughout monetary history, the contrast becomes unmistakable. Crypto represents possibility, but silver represents certainty, and that distinction matters even more in a world where confidence can shift in an instant. Volatility is often misunderstood. Most new investors equate volatility with opportunity, believing that large price swings offer a chance for oversized gains. But seasoned investors understand that volatility cuts both ways. The same movement that provides explosive upside also carries the risk of severe downside, and that risk becomes most visible when liquidity contracts. Crypto has shown this repeatedly. It rises quickly in periods of easy money, then falls sharply when financial conditions tighten or when market sentiment turns defensive. This is not a flaw in the technology, but a reflection of the asset class itself. It is speculative at its core, and speculative assets thrive only in environments where confidence is abundant. Silver, in contrast, has survived every economic system, every currency failure, and every political shift for thousands of years. Its value does not depend on sentiment or liquidity. It is anchored in scarcity, industrial necessity, and a monetary legacy that spans empires. While crypto has experienced multiple boom and bust cycles in less than 2 decades, silver's maintained purchasing power over centuries, not years. That is not an accident. It is the natural outcome of an asset that has intrinsic value and universal demand. When people discuss crypto's volatility, they often attribute it to innovation. But innovation does not guarantee stability. For an asset to perform a monetary role, it must offer reliability under stress. It must function as a hedge against currency dilution, a store of value during inflationary periods, and a safe harbor when confidence in financial institutions weakens. Silver has fulfilled these roles across every major monetary transition in recorded history. Crypto has yet to prove it can fulfill any of them consistently. Another critical factor is the absence of intrinsic value in digital assets. They exist within networks that rely on electricity, infrastructure, and technological confidence. Their value is determined almost entirely by what buyers and sellers are willing to believe at any given moment. Their supply may be limited, but their demand is purely psychological. Silver, on the other hand, carries value not only as a monetary metal, but also as an industrial component essential to modern energy systems, electronics, medicine, and manufacturing. It contains utility that does not vanish when markets panic. Even when investors hesitate, industry continues to consume silver because the modern world cannot function without it. This dual role, monetary and industrial, gives silver a level of stability that speculative assets simply cannot match. When investment demand weakens, industrial demand provides a floor. When industrial demand softens, investment interest rises in response to monetary conditions. This natural balancing mechanism is why silver never collapses to zero and why it remains relevant regardless of economic cycles. We also have to look at how each asset behaves during periods of crisis. Crypto suffers its worst declines when uncertainty increases because investors seek liquidity and stability. Tangible assets become more valuable during those same periods because they are not promises, they are physical stores of purchasing power. Silver has protected wealth through wars, depressions, hyperinflation, and monetary resets. It does not require a functioning grid, a trading platform, or a speculative market to retain value. It simply exists, and because of that, it endures. This is not an argument against innovation or against the potential utility of digital assets. Rather, it is a reminder that potential, no matter how exciting, is not the same as permanence. Monetary roles are not assigned. They are earned through centuries of reliability, stability, and universal acceptance. Silver has earned that role. It has demonstrated resilience through every form of financial upheaval. Crypto has shown promise, but it has not yet demonstrated that it can withstand the pressures that traditional monetary metals have endured for millennia. When you strip away hype and examine fundamentals, the picture becomes clear. Volatility belongs to assets driven by speculation, while long-term monetary confidence belongs to assets supported by history and intrinsic value. Silver occupies that second category, not because of nostalgia, but because of economic reality. Its role as a monetary metal is not theoretical. It is proven, tested, and repeatedly reaffirmed by the behavior of markets during times of stress. In the end, investors do not choose their monetary anchors based on excitement. They choose based on durability. Crypto offers opportunity, but silver offers continuity. And continuity is what truly defines a long-term monetary asset. In every major monetary transition, there comes a moment when investors ask what asset will carry value from this system into the next. Silver has answered that question for thousands of years, and it is answering it again today. Thank you for your attention, and as always, stay informed, stay rational, and stay ahead of the curve.